The boroughs are New York City. The burbs are everywhere else. Real estate is the ultimate game of risk and reward. It's the biggest investment most people ever make. Fortunes are made over a lifetime and lost in a day. And we're not playing with monopoly money. How do you stay ahead? Who's buying? Who's selling? And why? What do they know? We want the truth. You need an edge. Boroughs and Burbs is your secret weapon, giving you the insider knowledge and strategies you need to succeed in the high-stakes world of real estate. From Palm Beach to Palm Springs, Manhattan to Malibu, we press the experts to expose the pain, find the deals, and occasionally predict the future. That's Boroughs and Burbs, Thursdays, 3 o'clock Eastern, noon Pacific, because everyone can make money in real estate.
Boroughs and Burbs, episode 146. The mid-year market report. And I've got Sally Daley in Florida, Vero Beach, and I got my partner, Roberto Cabrera. Where are you, Roberto?
I'm on the Upper West Side of Manhattan.
All right. You're going to cover all of Manhattan, or you're going to cover all of New York?
Well, it's Manhattan, but we can discuss. It's also segmented. You know, it's a tough task. We'll deal.
All right. So, sharing the screen. There's Boroughs and Burbs. You can find us here, podcast.apple. You'll find us on YouTube, Spotify, iHeartRadio. Any place you want to find us, you're going to find us. I want to thank our sponsor, Grace Farms. This is the famous river building. They've got the 9th anniversary benefit coming up, featuring the London Philharmonic Orchestra. It's their 9th anniversary. It's coming up on Monday, October 21st at 6. You can now, as of this week, start ordering your tickets. It's going to be a big, big deal. $250 per ticket. That's a bargain for a room full of musicians of that quality. I want to thank Meet Sally, Sally Daley of thedaileygroup.com. And she is immersed, persistent, and trusted. There she is. Here's her website. $515 million in sales. We're going to find out how the Florida market is doing. Roberto already sent out his market report. Reports of my death are greatly exaggerated. I think he's going to tell us that New York is doing just fine, but I'll wait to find out. We may refer to the Miller Samuel market reports that are out. They've already put out more detailed reports on the New York and Florida markets. We may dive into that. Without any further ado, welcome. How are you doing?
Fabulous. You going to tell us about Connecticut?
As soon as I'm going to start with saying that as soon as Sally got on the phone and she said, "So, how's your summer? How are you thinking about the wedding?" And I said, "I am too busy to think about my daughter's wedding right now. I am busier than I expected to be, busier than I want to be in 100-degree humid Connecticut this week. It's hot.
Why are you busy? Why are you busy?
And the buyers are out. And I have to say that demand is not affected by interest rates. Demand is not waiting for Jerome Powell. Demand is not waiting to find out the results of the presidential election in November.
So, John, what's driving the buyer? What's their profile and why are they out there?
We put a house on the market for $2 million this week. And, a couple days went by because we're in the middle of break. And at the end of the first week, 3 bids came in and we went to highest and best. And it looks like another contingency-free bid, full price. I'm going to tell you that's typical in Fairfield County, where the average property and median property is trading at 100% of asking price. Days on market is in the 15 to 30 days on median and average throughout the county. In the less expensive markets of Norwalk and Stamford, where the average and median price is below $1 million, you're seeing the percentage versus asking price up at the 107%. On average, in Norwalk, we're seeing 107% of asking. So what this is telling me is that at the $2 million price point in New Canaan, and then sub $1 million or $1.5 million price point throughout Fairfield County, we have way too many, dare I say, millennials still trying to buy a home in a community with good schools, access to New York City, a great quality of life, parks, activities. So they come out here from New York City generally, but I'm also selling right now to a Swiss family that came in and made a full price offer at the $2 million mark for a fixer-upper in Darien. That happened last week. He said, I'm flying in for the weekend. I have to make a decision. We looked at 6 homes. He made an offer, and within the 2 days, he had flown out, and we've been working with him ever since to try and finalize this. And I've been accompanying the inspectors and talking with his bank and his lawyer and the mold expert and all the other professionals, the pool inspector, while he's doing his job from Switzerland. So I'm going to tell you that for the most part, we continue to draw on New York and trade up moves from the surrounding area. But occasionally we'll get a client from Texas, Florida, Switzerland, or London.
What's driving it seems to be that you have no product to sell. You have very low inventory.
I was just going to say that, Roberto. So it's a supply problem.
It's definitely a supply problem. Last year, we were down 50% from pre-COVID times. And this year, we have less supply than we did last year. I think that in the first 15 days, in New Canaan, just to use an example, I looked it up this week to write my column in the paper. In the first 2 weeks of July, we had 15 new listings come on. So they are coming on. But we've had 40 sales close in the last 30 days and 18 more go pending in the last. So you see that we're not resupplying the market as fast as the deals are getting done.
And so what's it going to take for you to get more supply?
I'm going to lean on people like Scott Hobbs, who's on the call, and who is a builder, and say,
come on, Scott, get on it. Build some houses.
He's leaning on you, Scott, to build 5 $30 million homes. That's really going to help.
If there was a plague that happened to kill a lot of people, there'd be a lot more supply.
But labor didn't get any easier for Scott Hobbs. Commodity prices didn't get any easier for Scott Hobbs. Financing costs didn't get any easier for Scott Hobbs, or his customers. So are we in a period of discovery on what new construction costs and should cost?
I would say yes. I mean, it seems like a lot of the froth on the building material prices has come off. So I think that we're in a stable environment as far as building material costs. Labor is still kind of undiscovered. There's plenty of people who will work and do construction stuff. And I think some of that pricing has actually come down. But if you're trying to build high quality stuff, the number of guys that can build high quality stuff, it continues to diminish. I forget who was saying this the other day, but it might have been the dirty jobs guy. But we have something like in the neighborhood of and this isn't the right numbers, you got to multiply by something, but we're having like 4 tradespeople retire a day and 1 person's entering the industry. And you multiply that across all of the trade type people and you're going, it's like, there is going to be fewer and fewer and fewer skilled workers inside of the workforce. And that's going to drive costs up. And quite frankly, it needs to, because, especially in areas where it's desirable to live, it's not like the tradespeople are earning, $500,000 a year. They've got to be able to live nearby. They've got to be able to pay for their car and for their gas and to clothe their children and to feed them and to send them to college and to do all that stuff. So it's, they have to earn more in order to stay inside the local economy. So that's going to be probably that dance as to what are people willing to pay other people in order to get what they want. And that's a tough question. And societally, we're going through that a lot in construction right now.
I'm going to lead the witness by saying what I'm finding is that in order to make up for a lack of supply, a lot of my buyers are willing to take on a project. Buyers who were not willing a year or two ago to take on a project. And I'm interested whether this is true for Roberto in New York City and Sally, but they're willing to take on a project now because they can't buy a finished product. So I'm wondering from Scott, whether are you finding that the renovation market has picked up and your clients who can't find what they want in the market are willing to renovate and expand?
I think in general, it's people have to do that. I mean, there aren't lots. I mean, so if you're going to buy, and by the way, because demand is so strong, people will live in houses that used to be a tear down. So, if you're trying to buy a lot, an old house at a discount to tear it down to build a new house, you have 18 people who are lined up to pay top dollar to use it as a house. So that's a tough equation in order to make that work. There's also, I mean, for a lot of the houses, I mean, ultimately housing is a depreciating asset and it's fashion. If you bought the very best 3-piece suit in 1980 and you tried to wear it today, you're not going to look as cool as you did in 1980. It's not going to work. And that happens on houses too. And in addition, you have stuff like the mechanical systems, they're 30 years old, they need to be replaced, the insulation wasn't right, the insulated windows are failing, the flashing.
Building code changes, yeah.
And design wise, it's like, I'm sure as realtors in particular, you still stumble across that Pepto-Bismol tile in the bathrooms occasionally. That was once the height of fashion. And actually some people have gotten that back a little bit, but it's very retro to do that. And these things just have to change. So it's people have to do a project. And if there is no other alternative, that's what you got to do, which is not for the faint of heart. And the financial world still has a problem with that, in that, getting a mortgage on a new house, relatively easy. Getting a mortgage on an old house, relatively easy. Buying an old house and getting the money to renovate, much more difficult.
All right, I want to ask Sally now. Before I just say, how's the market? I'd like to ask you to define your market. And I have to say that when Roberto and I were thinking about, who can we ask who represents the Florida market? The first inclination is to go find somebody in Palm Beach, but I don't think that Palm Beach is necessarily representative of the rest of the Florida market. So I find that you're in an elevated and a luxury market, and you could probably give us a better perspective on the non-Palm Beach luxury market. So what market are you in? How big is it? What's the average price point? And how is it doing?
We're in Vero Beach, Florida. We're about an hour north of Palm Beach. It's a barrier island community, so we have a tale of two markets. We've got the barrier island, where land prices drive prices further, and we've got the mainland. And we, in some degrees, have a tale of two markets. What's more important to understand, though, are two things. One, we are primarily a second home market or a work from home market. We are not a jobs-based market such as you have, John, where people are buying school district first. So that's the first thing. The second thing is that makes us a little unique, actually. We're the only county on the eastern seaboard that has low density housing. So to some degree, we've got this Teflon shield around us that insulates us from the vagaries of the market, because we've got by policy limited product. Most of that product, though, is 80s, 90s, early 2000s, when the market stopped and the faucet stopped and new buildings stopped and everything else stopped. And to Scott's point, you know, all our newer houses still have the formal living room and dining rooms, and a lot of them still have the black granite and the dark cabinets, and everybody's going, love Vero. What you got that's new? And our average price point is around 1.6 for the Barrier Island. We are not a seller's market. We used to be a buyer's, we used to be a seller's market. Now we're more of a balanced market. We're still only about 1/3 of the inventory that we always were pre-COVID. So, you know, when you see these internet trolls going, Florida's going to crash, it's going to crash, we all know it's hyper local, and we are nowhere close to pre-COVID levels, either for days on market or inventory levels, but we're balanced. And the big distinguishing factor is perceived to be move-in ready and new versus everything else. But mostly it's everything else.
On the Barrier Island, when you said 1.6, like
Yep.
what is that? What's a typical 1.6 get
It's
you?
probably going to be a 3.3, 1/3 of a lot, 27, 28 square foot under air, usually block with a barrel or a flat concrete tile roof, sometimes in a community with a private beach, usually built anywhere 1990 to 2004. And oftentimes, Roberto, the amenity is east or west of A1A with a private dune crossover. Private meaning, of course, you don't own it, but there's no access to the public, so you feel like it's yours. And in between two lots, there'll be a perpetual easement recorded for you to get to the beach.
You see a lot of cash deals?
80%.
Oh, that's even higher.
I think Florida, the beach communities of Florida are the only ones higher than New York. I believe that in New York, you're seeing what, 2/3, 67% cash.
We're like 60, 65%.
Yeah, Florida.
Now, of course, that's not to say they're not pulling something. They're not conditioning their contract on it. Let me
Sure.
qualify that. Although now with the cost of money, they probably are paying cash.
Why are you balanced, Sally, when what happened? Did the supply
Here's the story.
catch up?
The tail is in the numbers. Demand has stayed relatively the same year over year. The equation that's changed is the denominator. Supply has gone up. More sellers have jumped into the market.
And they're not making new product. This is existing sellers taking a profit, taking advantage of the prices. Where are they going?
Well, this is the issue. It's funny that you would say that, John. You just led me right into that. Thank you. I mean, this past week, I had 3 conversations with clients that were contemplating moving. And unless you really know where you're going to go, if you're going to stay locally, the cost of ownership and the cost of acquisition are both really inflated, right? So I had 3 clients where I said, you don't really know where you're going to want to go. Your in basis is pretty cheap. 0 to 5 years, you're looking at very, low maintenance expense. Your roof is fine. Stay put, because they don't need to tap into the gap differential. So the people that are selling are saying, I'm either leaving the area, going to assisted living. We have an older population, and we're getting younger and younger and younger. We're still not super young, but there's definitely an aging out of many of these communities. So that's what's happening. People are saying, I'm going to leave the area, but if you don't know where to go and you don't have the exit strategy, they're staying put because they're in basis. We all gained what, 40%, 50% pre-COVID. And if your roof is solid, you're not going because your insurance is cheap. I mean, I had one client, she was going to downsize to a decidedly lesser community, definitely a lesser house, even though it was brand new. Her maintenance would have been higher because her insurance was going to double, and it just didn't make any sense. So I said, love your house, don't move.
Why is the insurance calibrated low? Just curious.
Because she's had the policy for about 8 years, and it's this kind of grandfathered, reducing, vanishing deductible that they won't write anymore, Roberto. So if she terminates that policy, her new policy becomes $5,100 a year for a house that's 30% smaller, and her policy right now is cheaper for a substantially larger home.
Wow.
It's insurance.
It's almost like having a 2.5% interest rate. She's
That's
locked
exactly
in.
what it's like. That's an excellent analogy. That's exactly what it's like.
Wow.
So if you
So-
don't need the gap equity, there's no motivation.
So when we were just talking about things that need work, what is the discount like here in Manhattan? Our discounts got all the way down to about 70% of value for things that needed work. Now that has tightened a bit. It's probably more like 75%, something like that. What sort of discounts do you guys see in your markets?
Oh, it's nowhere that big, unless it really is a knockdown. And if it's a knockdown, Roberto, I coined this phrase, John, I call it house purgatory. It's these older houses that are not priced appropriately. You know, the condition and value are not consistent. And so they're priced too high to justify a knockdown, yet they're too high to dump a lot of money into. So they're in purgatory. Broadly speaking, we're still getting about 98% of ask. That's where we're seeing the discounts instead of 96, 97. We're not 100% like you, John. Year over year, we went from 96 to 97% of ask down to like 92, 93. That's where we're seeing it.
Is 92, 93 normal pre-COVID? 92?
Yes. Mhm. Mhm.
So there's an old adage in economics that high prices solve a lot of issues and low prices solve a lot of issues. And I think that, reaching that equilibrium is probably what we're seeing there in Vero Beach. And again, I think we see that to some extent everywhere because again, the prices are reaching a point where, some people have just plain dropped out of the market. At some point, sellers will actually be enticed to go ahead and say, I'm out. And especially as the mortgages turn over and other things, any other reason that they had to stay goes further into the distance or their cost of staying goes up. That'll likely motivate the sellers.
That's right. And some of our aged inventory, until they hit the right price, the market's a funny dancing partner. When you get to the right number, the market responds. But until you get there, none of them will clear.
All right, Roberto, it's your turn. I think you should start by defining how big is the market and how far are we from it now. I can pull up the charts in your market report while you're talking, but tell us.
I mean, I don't know what you mean by how big is the market. Our market is just so unbelievably segmented. It's really incredible. I mean, it's like going into the produce department at a Whole Foods. I mean, you have every different type of product there is. And everything's perishable, right? The longer it stays on the market, it starts to rot. And certain things are extremely expensive and certain things are not. Some properties sell immediately, whereas something extremely similar just down the street or on the next block just doesn't. So sometimes there's no rhyme or reason to what's happening. And our inventory, look, our inventory isn't tremendously ample, but we have things to sell. We have a lot of product on the market, in my opinion. The thing is people are just waiting.
I think of 7,500 listings throughout New York is normal. Is that
we're a little less than that. I think it's more like 7,100, 7,200, but that's deep. We should be able to move product, right? And one of the appraisers was saying nothing's happening. Nothing in Manhattan there's nothing wrong with Manhattan that a 10% price reduction wouldn't fix. It's like, and the thing is that we've had weeks. It's interesting. We'll see deal volume literally bump the moment there's a slightest even drop in interest rates. It's that sensitive. It's acutely sensitive to the interest rates. And there is demand, meaning that there are people ready to buy. And we have so much, we've been in such a flat place for probably the last almost 24 months now that it's pent up. It's pent up. The moment some of the uncertainty starts to dissipate, people are going to really, really come in. And right now, we've had uncertainty with interest rates and all sorts of policy-driven things, but now with the politics a little bit, it's becoming hyper uncertain for the next couple of months, and it becomes also notorious that deal volume slows in the presidential year leading up to the election, and then the election passes and everybody goes back to normal, like as if nothing ever happened. But there is the demand is there. It just, the clouds need to clear a little bit for some people, but there are people that are out and they are buying. They're making deals happen. There are some things that are also going for bidding wars and some things that are just sitting forever. So really no rhyme or reason.
I'm pulling up your market report, and the second chart at robertocabrera.com is specifically demand. And the bright white line is showing 2024. It looks like I think what you've just told me is that supply is at normal levels. And it looks like from this line that demand is at normal levels. True?
I would say it's slightly less than normal. What it is it's way below the big rebound that we had post-COVID in 21 leading into 22. So
that's the blue line at the top.
Yeah. So
You're
everything
spoiled.
feels, so in relative perspective, it's lower, right? But we're more in line with more of an average. But we should be, if the interest rates were 1 point less, it would be, volume would really be high, because I think we're 2 years behind where we have been really languid in moving the product.
So I just finished. I'm glad. It's a great segue. I just got an hour ago, my Bank of America Merrill Lynch said, watch this 15-minute market report. We're going to tell you what's going to happen for the next few years. I was like, oh, this is perfect for my show coming up. And they said that they expect 7 consecutive rate cuts over the next 7 quarters for a total of 3.5 points of rate cuts starting in the 4th quarter of this year. Now, I think the consensus is that we're going to get a rate cut in the 4th quarter of this year. This is the first time I've heard somebody actually say, when is it going to end? Well, it's going to happen in the last quarter of this year, all of 2025, and then into 2026. We're going to see rate cuts. Are you saying that this is going to goose the New York real estate market tremendously? You're saying the New York market is very sensitive to rate cuts. And if we start seeing consistency in rate cuts, New Yorkers will respond.
Yes. I think it's like the floodgates. It's just sitting there, and you see something pop every once in a while, like a leak. But if there's any sort of movement there, it's just going to break. There's too much demand, and the rental market is at all-time highs. We're seeing every single rental deal I have done in the last 2 months, and there's been bidding wars. Every single one.
That chart you showed me doesn't indicate that you're going to go back up to. You're suggesting
I'm not saying we're going to go back to 2021. We'll never get back to 2021. That was an anomaly. That'll never happen again. But it's going to jump. Right now our deal volume's down probably 8%. It'll probably jump from this point. It'll probably jump at least 8 points above what would be normal.
Now let's talk about those different segments, since you said it's a highly segmented market. Is there, during this period of wait and see and low deal volume, is there a flight to quality? Is there a flight? Are people trading up and taking advantage to get a better apartment in this market? I mean, where's the trend line?
The deals are happening where people are in must-move situations. There's a divorce. There's kids who've gone to college. They need to cash out. They need, things like that. Nothing. It's not out of preference. It's out of need. That's where I find all the deals are happening. In the luxury market, there are deals that are happening. They're all cash and that type of thing. But again, and those people are less sensitive to the interest rates, right? And on the lower side, where the people are sensitive to the interest rates, it's a tough battle. It's a tough battle because it's so expensive compared to what it used to be. But prices and the prices have not. See, the demand is enough where the prices haven't dropped. The prices are pretty stable, and that's pretty shocking. the prices should have dropped with the level of interest rate increase that we've had.
So if
Roberto,
the
I've
price,
got two questions for you. Sorry, John. I heard a comment from a colleague that said they're seeing a little bit of movement away from townhouses to buildings with doormen because of the perception of safety. Do you think that's baloney, or do you think that's a thing? And you're on the Upper West Side. Which are certain neighborhoods more immune? Are the co-ops out of fashion? Talk about micro market tastes and mini shifts that you're seeing.
So the townhouse market really became unbelievably popular from 2015 leading up to COVID. They really were. That was beachfront property. That's where you get the most space, et cetera. Post-COVID, that's where you saw the shift, and people wanted safety and they wanted to go to certain buildings. At the same time, because of COVID, people also were going in the opposite direction. I don't want to be in a building where I got to get in an elevator with somebody else. I want my own private Idaho. I want my townhouse. So where townhouses had peaked and then started to suffer coming into COVID, it kind of switched back. And now it's leveling off. It's a little bit of both. And one of the reasons why is because there's more luxury product. There's tons of things on Billionaires Row that hasn't sold, that type of thing. So there's just more products to buy than the townhouses. The townhouse market's a little tighter. And also a lot of houses need work. And a townhouse project is a big job, as Scott will tell you. It's $3 or $4 million minimum, running 10, 15 to renovate a house. It's a big deal. With regards to things that are a little bit out of favor, it's been a growing thing. All the apartments that are on Park Avenue, Fifth Avenue, those big, beautiful apartments that have tremendous proportions, they just aren't designed like they're designing things today in the way we live today. Today, we have big, huge kitchens that open to the living room. It's a different type of lifestyle. The biggest thing that I notice is that you have these gorgeous apartments, these enormous primary bedrooms. And then there's a bathroom right off of the bedroom it's a toilet, a sink, and a tub. That's it. You go into any new construction these days and it's designed, you walk in, his and hers bathrooms, tub, shower, bidet, dressing room. It's a different experience. And people walk in and they say, it becomes, I would love to live in this thing with old pre-war charm, but the building won't even allow me to renovate it to kind of reflect this, because there's rules about putting a wet area, expanding your wet area over a dry area in someone else's apartment and things like that. So there's a lot of restrictions, and that's really hurt that product. The other thing is that a lot of those buildings, and they're starting to ease them a little bit, a lot of these buildings have a tremendous amount of restriction on what you can finance. Some buildings, all of them are all 50% down at least for the most part. And then you get 70% down or no financing whatsoever. And that just eliminates a lot of people. Even the people that have the money, they don't want to pay up. And for example, there's a building at 927 Fifth Avenue is a perfect example. There's an apartment that started maybe 5 years ago in the market, 6 years ago, 33 some million. It's down to 26 million because they have summer work rules. It's an apartment needs to be completely renovated. Gorgeous, huge apartment overlooking the park. In order to renovate that, you can only work during the summer. That type of renovation is going to take you 2 or 3 years to renovate on consistently working. So it's an endeavor. You're going to buy something, you're going to live there for 4 or 5 years, and you have to carry it while you're living somewhere else. So there's a lot of challenges in that sector of the market.
Scott, you're nodding your head.
Well, and in the pre-COVID world, it was very difficult to do summer work. Today, with supply chain disruptions, which are a lot better than they used to be, but as Roberto says, it's very difficult to schedule this work anyway. And then to go ahead and say, okay, you're going to schedule it all, but then you can't work at all for 2 to 3 months out of the summer, meaning all the vendors have to go away. And then, by the way, you're going to be competing at startup with all the other summer rule people that allow work to start again after Labor Day. So it creates an artificial, a disproportionate artificial penalty to anyone who buys in the building.
And there's one service elevator. Everybody's sharing it.
Yep. So it just makes it, and again, there's reasons for it. And I mean, it's like, hey, if I'm spending the summer in the building and I don't want to have to be disturbed by construction when I'm working less, I get it. At the same time, it means your apartment, when it comes time to renovate it or sell it, you're going to pay a price for that.
Roberto, we talked about presidential election and creating more volatility in the real estate market. But I think that New York is also undergoing some election changes, right? Is Eric Adams running again? Is there competition? Are people? Is New York local politics affecting people's decision to move forward or not in the New York market?
No one's ever happy. So there's that as just a consistent like blanket layer over all of the city. But I haven't seen that is directly affecting anything at this moment. I have not. No one's talking about that. Not in my sphere. Not that it's not happening elsewhere.
If I've got an extra $2 million rattling around in my pocket and I'm not happy with the fact that prices haven't come down in the New York market, are those people looking at Vero Beach? Are they looking at flights and say, well, where else can I look? Can I get my fix? Can I get my extra space with a second home? Or has that market dried up a bit? Is that why Sally is experiencing a more balanced market than she was 2 years ago, that the money is flowing back into New York?
There's just, I think people come here because they want to live here, and you're buying here because you really want to be here, for no other reason. I mean, it's not like you're not like choosing Chicago or here or LA or here or Boston. It's like you want it. New York is very specific. You're coming
but
here.
Work from home didn't go away and is not going to go away. So I can get my job done splitting my time between Florida, a 3-hour commute away, and my New York apartment. So I might just stay put in my New York apartment, not renovate it, and go find something in Florida or Texas or North Carolina or wherever that I can get to with a direct flight.
You can. Sally, do you have people doing that?
Absolutely. And really ours hasn't been a decrease in demand. It's been an increase in supply. So it really, our demand really hasn't diminished. Our supply has increased.
How so?
Ran into
Why? Building? New builds?
No, resales. A handful of builds. I'm representing a bunch of new builders now, but again, it's a challenge. Scott, you can appreciate this. You pay too much for your dirt, you're sunk right from the beginning. You got to buy it right. So like I'm doing a project of 3 contiguous houses east of A1A, walkable to town. We're all, we're going to be in the high 4s for all 3 of them. But our in basis for the land was back in the day. I don't think we could replicate that project now. First of all, we couldn't find 3 contiguous lots, which gives you insurance against old abutters that you don't want to live next to. But the cost of the 2 make it impossible. But it's not that demand has diminished, it's that supply has increased as life inevitably, to Roberto's point, death, divorce, diamonds, diapers, distress, disease, the D's of real estate happen. And, you can only hold on for so long when the house becomes an impediment and you're sitting on a huge equity gain anyway. So it's the sellers that have changed our dynamic.
I ran into a guy last night who came during COVID from Westchester County, family with 2 teenagers. He specifically came to New Canaan because of the school, because St. Luke's School had a program that he needed for his son. So they specifically looked at houses close to St. Luke's School. And I said, how's it going? I love New Canaan. These are the biggest cheerleaders for New Canaan you ever saw. They put a lot of money into their house and they got a house with a pool. And I said, what's your favorite thing? He says, I love my pool. I spend all my time cleaning my pool, swimming in my pool. I spend all the time in the pool. And what do you not like? And he said, I didn't expect I was going to have to commute every day, but I'm commuting into Midtown a whole lot more. I run my own business recruiting firm in Midtown, and I got to be in the office a lot more than I expected. And the commute is tough. And so I have to say that we talked about this before COVID. Then there was work from home, and everybody said, oh, see, it's going to be fine. New Canaan real estate's going to do just fine because we're not so dependent on the commute. And what I'm finding is that a lot of people are having to commute, and the commute is emerging as an important impediment to our real estate market that we have to fix. I'm so glad, and I'd like to hear from Sally about the opening of the Vero Beach Airport and what impact that's had on your market, because the commute and transportation is essential to all of our markets.
Well, there's no doubt about it. It used to be you only bought a house in Vero if you were going to be here for several months at a time, or you had a beach house and you lived down in Miami and you drove up. But with the advent of our airport opening to Breeze Airlines, and they service MacArthur Airport and Westchester and Providence to get Boston, it's easier to get to and fro. So it makes it easier to say yes to us. There's no doubt about it, including work from home. I mean, I've sold several houses this year to young families that were leaving Greenwich, and the husband commutes back and forth as needed, and the kiddos are all in school down here. And, so they're coming down here full time. And again, what they're saying is what they could sell for, they sold for 10 or 11 million. And we got into a bidding war. It does happen on occasion, new product, 4.5 million. Well, that's a huge gap differential. But the transportation makes it possible because there's not the friction when it's not there and you only can fly private, or you have to go to Orlando, which nobody wants to go to.
How cheap does it get on Breeze Airlines for you to get to New York?
It's cheaper if you go down to, say, West Palm and do JetBlue. But if you monetize time, not so much when you're going, but man, when you get home and you're tired and you're only 10 minutes to get home, you love it on the return side. It's about 20%, 25% more, but everybody loves it. And they're doing very well. They've just increased the frequency of their flights.
But it's still like $200 round trip. I can get to New York and back.
Well, if you want to bring a bag, you can get to 400 pretty quickly. But
Okay.
Yes, if you want to, yes, you can.
Okay.
Do you have people concerned about hurricanes? I mean, like John says in Connecticut, he's like, coyotes are not good for business in Connecticut. And do you have people that are just, they're like, look, the climate's changing, more and more current, I just need to leave. It's
a huge concern. And the issue is that here's the RX for it, is education. I am working with clients that are in Fort Lauderdale, and they're used to elevation, FFE of 5 feet, 4 feet, 5 feet. We are not. We're 9 to 10 feet. It's a material difference, both in height. And when I explain it's a function of the elevation of where your dirt starts, and well as your roof protection and how your trusses are attached and your storm protection, then people start to understand it. And I'll say, okay, my house is 1990, but I've got windows and doors to 140 miles per hour wind shear. We've got full storm protection, and I've got a new roof to the Miami-Dade code, and we've had no trouble. People start to take a breath. But there's no doubt about it. Some people are saying, I just don't care. I can't deal with it. Give me just off. So if you said, what's our biggest trend? It would be just off the island, close enough that I don't feel like I'm in Paducahville. I'm reminded that I'm still in Florida, but I don't have that worry of having to evacuate literally on a rather skinny island, frankly.
Is the elevation immediately different when you get inland?
It's a little bit higher, but not tons. Not tons. The key is, what's the year of the development? Anything starting 1990, there's going to be an elevation mandate. There's going to be a requirement, whether it's fill brought in by digging the ponds or whatever, and it just makes a material difference. And then if you're talking about waterfront, it's an education, which Scott, you can appreciate this, about explaining what the codes were at the time that house was constructed. Oh, it's a 1980 house. Let's just renovate it. Well, let's do an archive pull and see. There's probably a monolithic slab and there's no pilings under there. And the reason why the pool is coughing up is because there's no pilings. So to some degree, you really need to understand the codes as well, because renovated is great, but what is the foundation when it was built? So it's all an education thing, just like I'm sure you guys have.
This is why you need someone local. You're
That's
listening to
right.
all this.
That's right.
Even the
That's right.
terminology, I'm like, what?
Yes.
Is she right, Scott Hobbs? Can I hire you to make my place hurricane proof?
Hurricane proof, yes. Coyote proof, no.
Okay. You make
But
fun
there
of
are
the
trappers.
coyotes, but I encountered a guy yesterday. I was like, "Oh, do you have foxes?" "I have foxes." And he goes, "No, I have bobcats." "Bobcats?" And he pointed to a pile of sticks and he says, "The bobcat lives over there." And he says, "We love him." So I've got foxes on my property. He's got bobcats. Some people have coyotes. You know, we're getting comfortable with wildlife here in Connecticut.
We
We
have
have
bobcats too.
raccoons.
We have bobcats too.
We have raccoons in Central Park.
And they are tough raccoons.
We can
You
send
should
you a
see 'em.
few
They like smoke
bobcats.
cigarettes. They're like
Hey, throw me your garbage.
exactly. So John, I'm literally your market seems to have a floor, a price floor, because I don't see how you can your inventory is not going to, it seems you're grossly under inventory.
Mhm.
And that's not gonna change.
I wrote in my last week in Darien, for example, there are 31 homes for sale, a 39% drop year over year from 51 a year ago and 74 in June 2022, 2 years ago. So we went from 74 to 51 to 31 in a town of population 21,753, same size as New Canaan, with half the inventory. And I said, why does Darien stand out in this peer group with less than half the inventory? And I do think that being on the main line, the main train line, commutable to New York City is a major advantage. And that's why I really wanted to underscore that when the gentleman came up to me last night and he said, the commute being an hour and 15 minutes is starting to weigh on me because I came from Westchester. I had a great half-hour, 45-minute commute, and now it's an hour and 15, and it's just too much. And he said, we'll probably be looking to make a change in the next few years as soon as our kid graduates the high school.
Well, it's an everyday irritant in your face, right, John? I mean, you
Right.
can't escape it. It's every day.
Ron, what did those inventory numbers look like pre-COVID, like 2018, 2019?
Oh, well, 2017 was a terrible market for Darien and New Canaan, and we would peak with 350 houses for sale in the late spring, before all of them had cleared and closed. I would say 250 was normal. So you should have 200, let's say in a town of 7,000 households, you should have 5% of them should be on the market. That's the conventional wisdom. That's going back 20, 50 years. 5% of your market should be, of your inventory should be on the market. So it should be hundreds. It should not be 31 to 75 houses, but that's where we are.
That just doesn't improve. Like, I mean, I don't know what you're gonna. I mean, so you got to get in there as early as possible, and just commit.
So Scott Hobbs is on the Affordable Housing Committee, and we're having that conversation here like anywhere else. And how do we, we have to make regulation changes, and we have to commit funding, and we have to get serious. Because if we allow the free market to just stay its course, land goes more expensive, houses go more expensive, and the average will go from 2 million to say 3 million, 4 million. And the problem Scott talked about of having our teachers, our cops, our firemen, our labor not being priced out of this market gets harder and harder. So we know it's a practical consideration. We want to provide, practically speaking, affordable housing. I think that in addition to what Scott and the Affordable Housing Committee are doing to create new housing stock, they're looking for land, they're trying to buy it, build it. In addition to that, I see planning and zoning, not only here, but all over, being more lenient about accessory dwelling units being built. I see, and while we're not getting credit for it at the state level for creating more housing stock. I'm watching every month multiple applicants say, I'd like to put in a little kitchenette here and a bathroom and a 1,000 square foot studio apartment on my property for my in-laws, for my children, and it's being allowed. So that's one way I see, practically speaking, that we're combating affordable housing. Scott can smile and say, I don't know if that's, you know, if that's going to solve our problem, but that's where we're heading.
Well, I mean, remember that housing is not a free market system. I mean, all of the zoning rules and all the restrictions, all the approvals, all of that has artificially compressed the amount of housing available. It's done for good reasons, and that, you know, if you're allowed to put up an 8-story building any place that you want with 100 apartments, I don't know if you get 100 apartments out of 8 stories. If you're, you know, with 50 apartments in it anywhere that you want, obviously quaint little New Canaan, you know, New England communities and places like Vero Beach are going to look significantly different than they do. And how do you deal with infrastructure and roads and schools and all of that stuff? But, you know, it's in a town like New Canaan that's essentially 100% built out. If you don't change the zoning rules, you can't get more density. You won't get more units. And, you know, I always challenge somebody to find me a desirable place to live that doesn't have an affordable housing crisis. Because, I mean, it's by definition, more people want to live there than elsewhere. And so there's going to be a shortage and the prices will go up. And there's no way around it.
So I want to ask both of you, or all three of you, what the outlook is, because that's where they ended the Merrill Lynch call. On a scale of 1 to 10, 5 being neutral, where are we and where do you see it going? And I have to say, the Bank of America economists were calling our current economy a 7 or 8. They said with positives, you have economic and market growth, strong corporate earnings was a big part of that, a healthy labor market, and consumers are still spending. But they talked about wars and geopolitical tension, election year volatility, and stubborn inflation being the risks. But they were, by and large, bullish and scored us a 7 or 8 and rising. What do you say, Roberto? What do you score into the New York real estate market? Is it healthy and getting better?
I think it's 4.5 to 5, and if we get a half a point to a point on an interest rate favorably drop next spring, it could be like 8, 8.5, 9. I really think it's going to accelerate fast. I think the pent-up demand is substantial just because we've been in this zone for 24 months.
Sally?
I agree with Roberto. I think we're starting slightly higher than you are, but I think we have tremendous pent-up demand. And I think our improvement will come with rates, but also when some of this old stock that's currently on, that's weighing down the market, that's not priced correctly, once it does and it clears by either going off the market or selling, it's going to accelerate. So I think this year is going to be a little pokey. I think next year and the year thereafter will be strong, getting stronger.
I would also score us at a 7 or 8 here in Connecticut. And I actually don't see any of these risks, wars, geopolitical tension, election year, inflation. I don't see any of those affecting our market tremendously. I think that the price of lumber can do whatever it wants. We're going to continue to have strong demand because there's 70 million millennials all trying to buy houses with good schools in community in desirable communities. So I see consistency. I see the fact that we're going to continue to have strong demand, low supply. We're going to continue to invest in our schools and our parks and our quality of life. And so I don't see this the situation changing for the next 24 months. I'd score us an 8, saying we're going to remain an 8. Scott?
So let's qualify that. 8 from a standpoint, not from a standpoint of deal volume, because you don't have enough to sell, right?
Right.
You're talking from a standpoint of strength.
I'm talking about if you came into my market and you said, find me something for $2 million. And I say, I can find you something for $2 million or $3 million or $4 million. And I have a high degree of confidence that you will not lose money on that in the next couple of years. You're going to spend it. We're already at an 8. You're already spending more perhaps than you would like, or that what you would have spent in 2017, but get over it. I don't think, Roberto, you're going to lose money in the New Canaan market, in the Darien market. And so when this guy flew in from Switzerland and he looked at houses around and he finally found one that needed a lot of work, and he said, am I going to get hurt? And I'm going to say right here on tape, you are not, what I said to him, you are not going to get hurt. This is a gorgeous piece of property on the Darien New Canaan line, and it will always be valuable. And barring you spending your money stupidly, I think that any dollar you sink into this house, you're going to get back. And he said, I agree with you. I'm going to buy the best gosh darn house I can buy in the best possible piece of land. And I think you're right. I'm not going to get hurt.
Well, and it's the same thing in Vero for different reasons. We still have tax advisors saying, go down where there's no, no state income tax. We still have an aging population. So to buy a house with good fundamentals, 3 or 4 off the beach, do I want to sink $500,000 into it? When I'm done, what is it going to be worth? It's going to be worth 2x whatever I put into it. So I agree with you, John. And we've got the added benefit of a low density zoning policy that is highly insulative of new product coming in, because we've got a fixed barometer, much like you do. So I would agree with you for different reasons.
Scott, I know you study economics.
I would first off say, please knock on wood when you talk about like wars not affecting us. I mean, it's like, please, come on. No, I would say again, I think that the fundamentals under housing are extremely strong. I would not be buying housing as a speculative investment at this point, although that may turn out to be wrong, because again, I think it's strong enough that it probably supports it. But I mean, if you need a place to live, rental rates are not low. Interest rates will hopefully go down at some point for a certain amount. If they do drop, then certainly again, there's going to be somewhat more, more people will be freed up to buy a new, to get out of their low income, their low interest rate and refinance at something that's acceptable. So we'll see more market inventory. And I think that would actually be really healthy, just to allow people to shuffle the deck and get more people in who want to be in and more people out or into the more appropriate places where they want to be. And I do agree that, again, barring some serious externality, things feel like they will move once we're done with the election, because right now, both halves of the world believe the world will end if the other side wins. And we know that can't possibly happen, but somebody's going to win. And then we'll move on.
Well said. All right. I think we're ending we're nearing the end of the hour. I want to thank our sponsor, Grace Farms, and remind you again, on Monday, October 21st at 6 o'clock, they've got the London Philharmonic coming to Grace Farms, and tickets are now available, and that is going to be the event of the fall. So come on out. I want to thank Sally Daley at thedaleygroup.com in Vero Beach. And it seems to me that before I made a move to Florida, I think I would call you regardless of whether I was looking at Vero Beach or some other place. And I might ask you, so can you talk to me about beyond Vero Beach, and have you got allies in the other communities, and can you help me throughout Florida?
Absolutely. 100%. Yep. I'm your gal.
All right. Well, I like the way you think, so you'd be my first phone call. And Roberto, of course, in New York, with 7,200 listings to parse through. I think I need a trusted advisor in New York. Are you that guy?
Absolutely. Absolutely. Are you the guy to help me with those 31 homes?
Yeah. I don't know. I mean,
your deck is getting really small.
I don't know. Roberto, that sounds like the Hunger Games, doesn't it? 31 listings. Holy Toledo. Are realtors like eating other realtors? That is brutal.
Well, I want to hear Roberto's opinion of that beautiful cape out in the north end of Staten Island. You know the one I'm talking about. I'm kidding. That's listing 7,112, something like that.
Yes.
I,
Yes.
it's brutal with 31 listings, and I have to say it has changed the market out here considerably. It is not enough to go on Zillow and look and make it a hobby to look at the new listings. You have got to call somebody who is turning over rocks. And I got a call yesterday from a New Yorker who said, I want a mid-century modern home. And I said, yep, get in line. I have several people asking me to find them unadvertised inventory. So in the tight markets, you've got to have a trusted advisor. I don't know if I'm always that trusted advisor. I think it's hyper local. I know I'm that guy in New Canaan, but you know, it really is a town by town phenomenon. And so you got to have a trusted advisor in each town working for you. Thanks, everybody.
Thank you. Thank you,
Pleasure.
Scott. Always great to see you.
I think we got 2 hours worth of content packed in 1 hour. So thank you all. And if you like the show, make sure you write us a review online. We would appreciate it. Thanks, everybody. Bye.
Bye.